This is Matthew Cratter from Trady University, and today I want to answer the question, did Powell and the Fed just end the bear market? We call this reading the tea leaves, and right now the Fed really is the elephant in the room. It's the most important factor in terms of determining whether the stock market and risk assets are heading higher or heading lower. So we got the results of yesterday's Fed meeting. The Fed decided to raise interest rates a half a percentage point, 50 basis points, on Wednesday to a Fed funds range of 0.75% to 1%. Unfortunately, don't expect to see much of this show up in your savings account at your U.S. bank. They'll continue to take advantage of you and me and not pay us very much interest in our savings accounts, even though they can now receive these much higher interest rates themselves. The other thing that we learned is that the Fed is going to begin shrinking its balance sheet on June 1st. We'll talk a little bit more about this later in the video. And then the thing that really set off the stock market rally was Powell talking about how 75 basis point hikes, in other words, 0.75% hikes, are off the table. This was the quote, "A broad sense on the committee that an additional 50 basis points increases should be on the table for the next couple of meetings." He also dashed speculation the Fed was weighing an even larger hike of 75 basis points, in other words, 0.75% in the months ahead, saying that is not something that the committee is actively considering. If we look ahead to the July meeting, this is the results of the July 27th meeting this summer, we see an 81% chance that Fed funds will be trading in the range of 1.5% to 1.75%, and just an 18.5% chance that it will be at 1.25% to 1.5%. So this is definitely pricing in a few more rate hikes. If we take a look at June is pricing in a smaller probability that the 50 basis point hike will take place then or intermeeting. This shows a 78-79% chance that the Fed funds rate will be 25 basis points higher than where it is now. So that's pricing in a partial rate hike. Either way, this was very good news for the stock market. Or the stock market took it as good news. We can see the big green candle from yesterday on the QQQs. On the other hand, when we look at this in context, we see how very far we have to go. The NASDAQ, the triple Q, is still trading below the 50-day moving average and below the 200-day moving average. We still had the death cross, and we've had a lot of volatility. So when we scroll out and look at yesterday's rally, it's really hard to say that it's much of anything. I would suggest that it's more of a relief rally, and I'm going to give you my reasons for that. But before I do that, I'd ask you to just hit that subscribe and like button if you haven't done so already. This is what Powell said. He said, "We need to do everything we can to restore stable prices as quickly and effectively as we can. We think we have a good chance to do it without a significant increase in unemployment." In other words, tightening so much that you get a recession and it hurts the job market, or a really sharp slowdown. Now, I think this is very unrealistic. As part of the Fed statement, they also said the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer term. These are their two big policy mandates, and they want an average inflation rate of about 2%. We've been closer to 8%, and so that almost implies that you need to have some sort of deflation or much lower inflation to bring it down. Powell goes on to say, with appropriate firming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. This is really what the market like to hear, but it is what we used to call a Goldilocks scenario, where inflation gently recedes. It gets back down to the 2% range. Stocks rally. There's no recession. You get what's called a soft landing, where the Fed's able to tighten without really blowing anything up or causing a recession. Rainbows and unicorns breaking out all over the world. I don't think this is going to happen. I think instead we're going to continue to get a stock market sell-off, possibly a volatile crash that forces the Fed's hand to reverse course and turn the money printers back on. Either that, or if the Fed stays too dovish, we'll just get persistent high inflation, and this is very dangerous politically. This is a sovereign debt crisis that we're experiencing now. It's not your normal Fed cycle. And the problem, as we've talked about many, many times, is the U.S. is running these huge budget deficits. There's no one left to take up the slack. The Fed at some point needs to print money and buy the debt that's issued by the government to fund this deficit spending. The annual budget deficit has been over $2 trillion for the past 12 months. And this is money the government is spending that it doesn't have, so it has to borrow the money, has to issue debt, securities, U.S. treasuries in order to fund this. And someone needs to buy it. Russia's not going to buy these treasuries. China's not going to buy these treasuries for obvious geopolitical reasons. And as such, really the buyer of last resort is the Fed. If they don't buy, interest rates will continue to skyrocket, and we will see the effect on risk assets like stocks and housing. I'm going to link to the FOMC statement from yesterday, but I thought was especially significant was the opening remarks from Jerome Powell's press conference, which was held immediately after the Fed statement was released. He starts off by saying, "It's nice to see you in person after the pandemic." And then I think this is the really important part here. I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve it will take to restore price stability. In other words, to go after and attack inflation so we don't see such high prices at the gas pumps and at the grocery store. The economy and country has been through a lot over the past 2 years and has proved resilient. It is essential that we bring inflation down. And I think this remains Powell's chief mandate. There's tremendous political pressure for Powell to do something about inflation, especially ahead of the midterms. And we can't underestimate I don't think the Fed has been politically neutral for a very, very long time, if ever. So this isn't just a Biden administration thing. Obviously, Trump exerted a lot of pressure on the Fed as well. And so inflation is a political problem. And to the extent that the Fed goes after and continues to attack inflation, it's going to be very bad for the stock market and bad for Bitcoin as well. Now let's talk a little bit about the Fed's balance sheet. We can see the historic rise in the balance sheet from March of 2020 to the present. This is basically securities, U.S. treasuries, and mortgage-backed securities that the Fed prints up brand new money and buys and puts them on their balance sheet. Balance sheet currently stands at almost $9 trillion. By contrast, at the last time we had the great financial crisis back in 2008, it was below $1 trillion. So it's gone up 9x over the past, call it 12, 14 years. So the Fed has said that they're going to start shrinking their balance sheet beginning June 1st, and they're going to shrink it by only $47.5 billion per month. This is mostly just allowing the securities that are on the balance sheet to mature and what's called roll off or run off. They're not going to be actively selling treasuries or mortgage-backed securities, it looks like. This is what's called quantitative tightening. Quantitative easing is when they grow the balance sheet. Quantitative tightening, or QT, is when they shrink the balance sheet. And whenever they've tried to shrink the balance sheet in the past, it's blown things up. This happened in 2018 and 2019 when they were shrinking it, and we got a very bad stock market at the time, as well as a bear market in Bitcoin. Now, this number of shrinking the balance sheet by $47.5 billion per month is much smaller than the initial projected monthly amount that we've been talking about that was proposed in Fed Minutes earlier this year. And I made a video about this about 6 weeks ago. They'd been proposing to shrink their balance sheet by about $95 billion per month. In other words, $60 billion in treasuries and $35 billion in mortgage-backed securities. Again, mortgage-backed securities are just these complex securities that are built up out of mortgages. And when the Fed buys MBSs, it keeps mortgage rates low and helps to stimulate the housing market. And to the extent it lets it run off, then there's more interest rate pressure, higher interest rates on mortgages as well as treasuries. So this is one reason the stock market was rallying. I think the market had been worried about these much higher numbers in terms of shrinking the Fed balance sheet. And instead, they're going to start small, and then they're going to possibly increase that after a couple of months if things do not blow up. So this was another reason we got such a strong stock market rally yesterday. Now, a lot of you have asked me, why has the balance sheet continued to go up? If you take a look, it's actually marginally moved higher even after they stopped adding to their balance sheet a couple weeks ago. Well, the main reason for this, there are two main reasons. Mortgage-backed securities can take months to settle, so we see mortgage-backs that they bought a few months ago finally settling and being added to the balance sheet. So the money's already, these have essentially already been purchased, and they're just waiting for the trade to settle. It may also be some coupon payments hitting their balance sheet as well. So treasuries pay an interest rate. They pay a yield, as do mortgage-backed securities. But this balance sheet, they are indeed going to attempt to shrink it. I think this is what's going to be very, very bad, continue to be bad for stocks and for Bitcoin in the short term. So what do I expect to happen next? I'm expecting fierce rallies, snapback rallies, what you might call relief rallies, but also lots of sharp sell-offs, lots of volatility and choppiness. We've entered a seasonally weak period for the stock market. There's this old expression, sell in May and go away. The May through October, really May through, call it the middle of October, is seasonally a very bearish time for stocks. There tends to be lower liquidity during the summer and a lot more choppiness, and having an uncertain Fed just will add to this. I thought Michael Burry of the Big Short fame had a great tweet yesterday where he talked about how strong the bear market rallies can be. And he has a chart here that shows you that bear market rallies in the 2000 and 2002 bear market averaged 23% and averaged 22% in during the Great Depression and the stock market sell-off from 1929 to 1932. So even though the trend is downward, you can have these very large snapback rallies. Here's a rally of 35% off a bottom. The general point here is that even though the general trend is down, you can have these very sharp relief rallies, which makes it difficult to try to short the market in a situation like this. And I don't recommend that. I recommend being on the sidelines to the extent you can and building up cash in order to buy stocks and Bitcoin when we get closer to a Fed reversal. So I still think that stocks are headed much lower this year. We talked about the political pressure on the Fed, and I think they will continue to shrink their balance sheet and hike rates, and that this is definitely creates strong headwinds and a bearish environment for risk assets. This is going to happen. I think stocks are headed much lower. Bitcoin's headed to 30,000, maybe below, unless the Fed reverses course. And there's really no sign of them reversing course. They were a little bit more dovish this time around, but I think the political pressures of inflation are still much stronger. I wanted to end by talking about what does a currency failure look like as a way of talking about volatility in the market. So what I have here, this is from Myrmicon Research. I've shown you guys this a few times. We have the white line here, which is the price of gold in Weimar marks. And as we all know, there was this hyperinflation in the Weimar Republic after World War I. And so what we have here is gold priced in the local currency, priced in Weimar marks. And they did a lot of money printing. As they did all the money printing, the price of gold skyrocketed. And it went from, this is sort of indexed to 1914, when gold was priced, call it at 1 Weimar mark. This is obviously being indexed, so it's not exactly that, but this gives you the relative change. It went from being priced one, call it whatever it was, an ounce of gold or something was 1 Weimar mark, and it went to 1 trillion Weimar marks along the way. Again, this is a gold priced in that local currency. But what's extraordinary is if we just look at the white line, it looks like gold melted up and it was a very easy trade. But what in fact happened was the blue line. This is the percentage, this is the monthly percentage change in gold price. So we had months where the price of gold went up 80%, 100%, 160%, but also months where the price of gold was sharply negative, down 20, 30%. Or more. And this just shows that this shows one reason that when a currency is failing, as the US dollar is failing, and as the whole fiat system is currently failing, there's going to be a lot of volatility of risk assets, of gold, and of Bitcoin, which is really gold 2.0. So it's not a smooth path to Bitcoin getting to $1 or $2 million or $10 million per Bitcoin, it's a volatile path with really large monthly ups and downs. But if you can hodl, if you're not using leverage, this is what it looks like. This is what a currency failure looks like. And it's going to be much more severe this time because obviously the Weimar mark was not a global reserve currency. We have the US dollar instead that's failing. It's not going to fail overnight. It's going to be a very volatile path where the Fed tries to save the currency and hike rates, ends up killing risk assets, and then turns the money printers back on and kills the dollar by printing more dollars. And as a result, you get this huge volatility in risk assets. And I think this is what we've entered. This is the regime we've entered. So I would continue to expect a very volatile summer for both stocks and for Bitcoin. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.